What's going on there? It's Tuesday, May 17th. I'm Frank Curzio. This is the Wall Street Unplugged podcast where I break down headlines and tell you what's really moving these markets. It's so refreshing to see the markets bouncing back today, including Bitcoin. However, we just went through 7 straight weeks of declines. 7 straight weeks. Not talking about small declines either. Major declines, very, very steep. Every single week, watching a portfolio go lower and lower. As inflation runs wild, Fed's about to start reducing its balance sheet by hundreds of billions. They didn't even start yet, guys. And they're going to continue to raise rates at least over the next 6 months. Based on inflation and where it is, if it moderates or not, that could be more like 12 to 15 months. Hopefully it's not that long. So you guys need to hunker down. It's going to get choppy. What we've seen for the past, not even just 2 months. I mean, massive declines over the past 2 months, but even since November. Different market. Now, I mentioned past podcasts. I think we're at levels that many stocks are strong buys. I love the Walmart and Amazon misses. Walmart missed today. Kramer's throwing a little bit of a fit because he has his portfolio and he got it wrong, which is fine. We all get some things wrong. However, they missed their quarters, and a lot has to do with higher expenses, which they use to pay employees more money, lock them in, critical in this type of market. Take a step back, 1 step back, 2 step forward. I know you have supply chain issues, so Walmart was kind of a surprise in a market with inflation, with people cutting back. You're looking at the Walmarts and McDonald's supposed to do well. McDonald's is starting to pick it up, but it was a surprise. I'd use it as a pullback, though, to buy Walmart. Especially, you're going to have Kramer, the soundboard is on CNBC. He's going to be trashing it, going crazy. He's probably going to knock it down even further, which it did. It was down 6%. It was down 3%. Then when the market opened, then when Kramer started just going off on it, it went down 6-7% again. Very influential, which is fine. Use it to your advantage. Walmart's a good company. They're going to get it right. People are still going to shop there. For the market as a whole, we really have a lack of catalysts for, the next 3 months minimum? As we're hoping inflation moderates? And you look at earnings season, mostly over. 85% of the companies already reported. We had Home Depot and Walmart report. They always report late in the earnings season. But 85, close to 90% have already reported. Ukraine-Russia war not ending anytime soon, so food and energy inflation is going to continue at least over the next few months. We're looking at this summer. Going to see more people travel, go on vacation. So the travel stocks they're bouncing, but back and forth, but they definitely bounced sharply off their lows. But I don't know if you guys travel lately. I don't know if you've gone on vacation since COVID, because, COVID was 2020, early 2020, so that summer was done. The next summer was done because that Omicron come around. So a lot of people out there haven't traveled. Some of you have, but most haven't. You're going on, hey, I'm going on vacation. This is the first time where everything is open, no masks, almost no restrictions. I've traveled, and holy shit. I mean, gas prices are up 40% year over year. Rental cars are up 24% year over year. Hotel rates are at record highs. Holy cow. Holy cow. I mean, they're just surging. Food prices at 14-year highs, and airline prices are up 19%. Not year over year like the rest of the stats I just said. Month over month, airlines are up 19% going into summer. Covering those fuel costs. So I say you got to own an airline. See demand come back. So I'm sure most families are still going to go on vacation this summer. No doubt about that. What I do doubt is I'm not sure they're going to have much left to spend on anything else once they get back. And that hurts the economy. We have supply chain concerns not going away anytime soon. May 5th, the Shanghai Japanese Commerce and Industry Club, that's actually an organization, they published a survey of Japanese factory owners in China. This is a survey. Nearly 2/3, guys, 63% of Japanese factories in Shanghai have not resumed any production yet. They're still closed. This is from 2 weeks ago. A lot different from what China's saying. Also, 28% of the rest of those factories have only restored less than 30% of their capacity. So we're looking at 90% or over 90% of Japanese factories not even close to being back online. And it's not just Japanese factories, but it's a good indication. Because that's something China can't lie about, because Japan has their factory production. We all have our factory production. And when notice that production is coming down tremendously, China's saying, no. We're opening up slowly. We don't have this massive zero policy COVID anymore. That's bullshit. Lying again. China's still locked down. We're going to have supply chain issues. Even China's locked down. What are they doing? They continue to ramp up coal usage, which is brilliant. Nobody else wants to use coal. Like, if we stop using coal, we're going to save the planet. Doesn't matter if anyone else in the world uses coal, right? Doesn't matter. Even though we only account for 11% of emissions, right? Carbon emissions. But it's incredible when you look at the stats. And you're going to see a lot of countries take advantage of it. And they are. They are. And China's perfectly okay to export that to you. That's fine. You just don't do it in your country to sell, check off the politics box, right? That's okay. They're building stockpiles of food. China's the largest agricultural exporter in the world. So when it comes to corn, right? Not just coal, but corn. China's holding 70% of the world's corn reserves. When it comes to rice, they're holding 60% of the world's rice reserves. And wheat, they hold over 50% of the world's wheat reserves. Yes, it's going to result in massive inflation on the food level, which I spoke about. They own fertilizer companies right now. Especially how choppy they are. You get them on 10, 15% pullbacks depending on what the market's doing. But what about the people in third world countries who are going to starve? We don't talk about that much in America, do we? No, it's not important to us. It's important that we're paying higher prices. But either way, there's a market podcast. And that is not good. That's less money in the pockets of consumers, which means they're going to spend less money into the economy. And you're looking at that spending accounts for over 70% of GDP. But inflation's not going away anytime soon. So a lot of these problems, and you look at them, they're not long-term. I mean, inflation, it's not something that's going to be around for many, many, many years. But it's going to be around for the next few months. It's not going to just go away. You're going to see it moderate. And inflation is the number one risk in the marketplace by a mile. We pounded the table on this for 2 years. People don't understand inflation. They don't get it. They don't understand when that happens, the Fed's not going to be, it's not going to be a buy a dip. It's going to be sell the rip instead because the Fed is not there to guarantee, to backstop. The only way you control massive inflation is by forcing a recession, which means you're taking money out of the system, which they're doing now. And we're talking about trillions in leverage. Trillions that needs to come out of the system, which you're seeing. And a lot of it is leverage, which is why your favorite companies that are doing great, that reported great quarters, are down 25, 30%. You go, why are people selling this? Because they bought it with money that they did not have. And now they're being forced to even sell their better things, which are not down 80% like SPACs and all the other shit. And they're starting to sell their good names to cover that. Because a lot was bought on debt. That's what's going on right now. That's what happens when you have a deleveraging process. It's not pretty. But when you look at inflation, it's not war, it's not politics, it's inflation. If inflation eases, which we're going to see, right? Higher prices are going to cure higher price. People aren't going to continue to pay higher prices forever. You're seeing a lot of companies say that we can't no longer pass those prices off, and it's going to happen across the board as people cut back. You just can't afford everything. Gas prices, energy prices, food prices. They can't afford to spend as much as they were. And they're going to cut back in their end. They're changing their habits now. You're seeing it. I'm seeing it in earnings season. I'm seeing it. A lot of companies reporting. You're seeing it right now. But if inflation eases, almost every one of these problems start to go away. The Fed doesn't have to get so aggressive in tightening, which we're worrying about. Supply chain concerns are going to ease. The Russia-Ukraine war, well, that's inflation on so many different levels. But assuming Russia-Ukraine, it's not a war. It's going to go on for many, many years. And that's going to ease. But again, when you have inflation coming down, it's not going to hurt as much. So we're close. Stocks are down huge to account for all these risks. You look at the NASDAQ, more than half of the stocks in this index are down more than 50% from their highs. That is an insane stat. That is an insane stat, guys. You almost never see that. I mean, that's unbelievable. That's just a massive sell-off of everything, right? That's when you know it's a deleveraging process. That's when you know a lot of debt's coming out of the market when everything. There's not even safe havens. Gold used to be a safe haven. Gold stock's getting wrecked. They haven't been really the safe haven. You can say, oh, they're not coming down just as much as everybody else. Yeah, you're right. But, and they went up barely over the past 6-7 years while everything tripled, quadrupled. Bitcoin has come down, seen as a high risk asset, which I get because the leverage could be 30, 40 times in some of these, depending on where you have your account. A lot of these kids leverage like crazy, and now you're seeing that. A lot of money come out of the market. But just unbelievable stat. Biotech names down 70%. I mean, the average healthcare company is down 75% from the highs. The average healthcare company. I'm not picking small caps. I'm not picking just biotech. I'm just the average healthcare company. It's down 75% from their highs. What? They're great technology in a biotech. Their phase 1, phase 2 that they passed. I mean, are they not going to get funded? Of course they're going to get funded. It's amazing. See more companies trade under their cash value, their net cash. More companies today than during the credit crisis, which is insane. That's how far down we have come. We are close. Yes, there's a lot of risks out there, but we know we're talking about them. We just need inflation to ease. Because a lot of these risks are starting to be priced in. I mean, you could, small caps as well, trading at cheaper valuations compared to April 2020, the bottom of the COVID crash. Small caps right now, really? You're trading at those with total uncertainty, whether, you don't know if people are dying from, COVID. We don't know anything about it really in April 2020. In March, we're just starting to spread everywhere. Everything's closed. The uncertainties. Small caps should be trading below those levels from a valuation standpoint. With earnings still growing? I don't know. But you want to own equities. You probably want to start picking away now. And how do you choose what names to buy? Well, earnings season's just about over. Make sure you listen to the conference call. But now you're going to see these massive buybacks, these levels from companies with strong balance sheets. That's going to trigger. They're going to be allowed to buy their stock. It's like a kind of a quiet period. Also, insiders going to be able to buy. Make sure you're focusing on insiders. I wouldn't even look at the 13 Fs, which are accounted for last month because a lot of things have changed. We have Buffett buying Citigroup, which Citi is going higher, but I wouldn't really, Buffett's different. He buys stocks and holds them forever and adds to them over time. But a lot of these guys are shifting and getting out of technology and blasting out of technology. They probably, compared with what they did last quarter, not last month, but last quarter, and blew out all these technology names. If I was them, just like David Tepper said, listen, my NASDAQ short's off. They're probably starting to add right now. So I wouldn't look at 13Fs because so much, I will look at a market in the past 3 months. It's NASDAQ's down, 22, 23% over that time frame? I mean, the market's gotten smashed. So don't look at that because a lot has changed from what they decided to do with their portfolios compared to what's going on right now. Again, they're reporting 3 months from now. But look at some of these companies that had 2 strong quarters. The last 2 quarters were really strong. Yet they're down with the rest of the market. It's a lot of names there. Make sure the companies you have that you're going to buy have growth catalysts and not just dirt cheap. Make sure there's growth catalysts. Make sure they have pricing power. Yeah, look for insider buys, starting to see that. But 20% of the S&P 500 is now trading below 10 times forward earnings. That's a lot of names. That's 100 names right there. I would start there, just at those 100 names. Look at some of those insiders buying, which ones are paying a dividend, which ones have strong balance sheets, which ones are down 20% plus for no reason at all, and they reported good quarters. You're going to get at least 10 really cool names that you're going to be able to say, holy shit, I can't believe these companies are at these levels. I'm going to buy them, and looking 2 years from now, inflation's going to moderate. 2 years from now, the Fed's going to start easing again. Yes, that's far away, but remember, where stocks are, you have to account for that. All the risks that we're mentioning, inflation and stuff like that, we've been talking about for a while. We see these risks on the table, and stocks are reflecting that, more than reflecting that right now. So if you have a long-term horizon, or if you're in there, you didn't sell it, you're going to see, listen, it's going to be choppy over the next few months. It's going to be a little crazy. However, inflation is going to ease. You're seeing it on some levels. You're not going to see it with food and energy for a little longer, probably through the summer. But as we ease, and we will, that's going to be a catalyst. The Fed hopefully gets aggressive when they're raising rates, shrinking their balance sheet. This way they have a lot of ammo, maybe 12, 18 months from now. And you want to be in before that point, because you're going to see stocks start rocketing higher, just like there's crashing right now, factoring in this massive inflation that we have. The reverse is going to happen at these levels. There's a lot of good names out there. A lot of good names that you could pick away with. Again, I talked about Walmart, Amazon at these levels. I mean, Microsoft, Apple. What's changed? What's changed? And you look at the NASDAQ and how much it's come down. I mean, not every tech stock's the same. You have crazy valuations, SPACs in the tech sector, cloud, AI, social media, software, e-commerce. Crazy valuations across the board. But not Microsoft and Apple. Bargains here. Netflix, 15 times forward earnings. And they're going to start growing their sub base again. You got a lot of those free people with passwords, right? That they're going to subscribe. You got Ozark, Stranger Things. They just have great content compared to everyone else. People are going to subscribe. You're going to see that number grow. But many of those names down 50% plus, they don't deserve to be down that far. Definitely a time to start picking away. With that said, it's a crazy market right now, so I'm going to change the format a little bit here and take more of your questions. So I'm going to take some of the questions today, send more questions at frankcurzioresearch.com for tomorrow. Daniel's on vacation. Vacation during this time. Man, pay that guy way too much money. No, Dan deserves vacation. He works his ass off. But Daniel is on vacation. So we usually have that segment where, Daniel and I talk about the markets. I'm going to take questions. I'm here for you. It's a crazy market. I know it's been down 7 weeks. Yes, it's nice to see it bounce today. Tomorrow, who knows what's going to happen? Hopefully we get 1 week where the market's up. 7 straight weeks of declines is incredibly, incredibly painful. And those declines aren't like, 0.3%, 0.7. I mean, we're looking at massive declines every week that we go by this. And it's been incredibly painful for a lot of people. And I get it. So I want to be here for you. Ask questions, frankcurzioresearch.com. Let's take a couple today. So first one's from Jeremy. He goes, Frank, where do you recommend storing your crypto utility tokens? I have kept my coins on the crypto exchanges thus far, such as Coinbase, Voyager, etc. Coinbase is recently disclosed in their 10Q. The crypto assets we hold in custody on behalf of our customers could be subject to bankruptcy proceeding. Do you see this as a real risk, or is it being overblown? I've opened a MetaMask account. Would you recommend transferring all my coins from MetaMask versus USB drive? Thanks again. You never know what's under the hood for any company. You really don't. In the U.S., we have some of the best regulations. CEOs have to sign off. They're going to go to jail. So you don't see it often, but you do see it sometimes. You don't really know. For me, I have crypto stored on Coinbase. I'm not moving it. I'm not going to tell you not to move it or whatever. I'm just telling you. I really don't know what's going on under the hood, but I'm not worried. I also have crypto in cold storage, like you said, offline. MetaMask as well, or MetaMask that I've talked to people who are really in this industry worry because they hear about it getting hacked sometimes in MetaMask. As for Coinbase and disclosing that risk, look, most companies, and I love this with disclaimers, I mean, they disclose every single crazy risk in their filing, so they can never get sued. And most people never read them, and the lawyer's like, just throw 30 pages of risks in it, no matter what it was. And we did that too at our company. You got to just put every single thing in there, and basically it's like checking a box. Like if a tree falls on my building and I'm in it, I could be injured and fail to do my duty as CEO, and that could cause a stock to fall and go bankrupt, whatever. All right, well, a lot of this stuff's just crazy, but disclaimers are funny these days. I saw one the other day that said, if you're taking this antidepressant as a commercial, it causes suicidal thoughts. And I've heard that before. But you know what I never heard? Afterwards, they said it causes suicide thoughts, but mostly in people who are under 25 years old. And I thought that was incredible when I listened to it. Even though it's stupid, I listened to some of those things. But that disclaimer never had an age on it before, the suicidal thoughts thing. And they actually made sure that they had a study with that because most people taking antidepressants, and they're some are under 25, but the core market's well over 25. So right away when you list that, it's kind of not even a risk, right? If you're over 25, basically. So, but yet you have to say it. You have to say it. You have to go through this. And it was never like that, like with healthcare companies where they take out a minute ad and, 45 seconds is this could cause this. Like, it's just hilarious. Sometimes I tape it and I'll post it and it's like, you really want to take this drug. It's funny, but every single possible risk. But, when it comes to disclaimers, it's throwing everything in there. Some of them are even useless. I mean, again, a lot of that's throwing this so companies won't get sued, but most of the disclaimers, especially in commercials, if you see them on the bottom, you can't even read them. They're like in a 4 font size, and you can't even read them. They put them on, and sometimes I read them really fast and stuff like that. My point is, they have to say a lot of this stuff. They have to say it's an ongoing risk. If Bitcoin goes to 5,000, you may see that. Okay, you may see that. You may see there's going to be a lot of disruption in a lot of these places. Maybe you want to hold your crypto someplace else. That's fine. For me, I'm not. I don't see that. Doesn't mean you shouldn't do it, but I wouldn't be worried about that. It's a great story. It's a great headline. It's great to pump out there, especially for short sellers who are short Coinbase, that you want to get that every place, all over the place, and all your Twitter networks and everything, and scare the shit out of everybody so they sell the stock, which worked. And, look, Cathy Wood did a good job of buying it. Not previously at 300, whatever it was, but she did buy it on, that massive sell-off last week when it went down like 20% in a day after earnings or whatever. And the thing popped, I think, 30% off its lows, but still down tremendously. However, not giving credit Cathy Wood here because I know she's bought a lot of these stocks and her fund's getting murdered here. But my point is, sometimes a lot of these things are smoke and mirrors, and you could use them as a buying opportunity. I wouldn't worry about that. I have crypto stored on Coinbase. I have MetaMask. And I also have, cold storage offline. So, all three of those, but I'm not removing mine. You can choose to do what you want to do with yours. Next question is from Roland. He goes, hey, Frank. So I own a small farm outside of Green Cove Springs, Florida. I've wanted to build a barn for a while now. Lumber price is so high, it's been hard to pull the trigger. I've been tracking the price of lumber. A 2-year chart looks like they might have formed a double top. It went as high as 1,700 and now has dropped below 800. I drive semi-trucks for a living. I've noticed there's a lot more lumber being moved around out here on highways loaded on flatbed trailers. Anyway, my question is, do you see lumber prices continue to come down over the next year or two? And will lower prices reach the consumer level? The price of lumber has been cut in half, but lumber prices at the consumer level are still at record highs. Should I hold off on building my barn and wait for lower prices, or do I just need some Frank Curzio stock picks to hit big so I can afford a barn at these current elevated prices? Thanks, Roland, member of a bunch of our newsletters. Thank you so much for the support. He goes, P.S. I've been investing since the 1980s, so I've been through a lot of bad markets. I seem to always make the wrong decisions during them. This time is different, though. I'll just sit back and relax and sell if you say to sell, or hold if you say hold, and buy if you say buy. It's very comforting to know that you know what you're doing. Please tell me that you know what you're doing, Frank, right? And he has like a couple smiley faces. I try to say I know what I'm doing, although my portfolio is down like the rest of you, right? This market really came down. I thought we would see a 10-15% correction. I tried to adjust the portfolios accordingly and sell some of these stocks, and then went down a lot further, but I didn't think it was going to come down 50%. With the average NASDAQ company, and some of these names down 25, 30, 40% is insane. It really is. So yes, I'd like to think I know what I'm doing. At least I'm trying. But let's get to your question about lumber. It's hard to say in a consumer level whether it'll filter down. Just like when oil prices came down, you didn't really see that relief at the pump. Just very little. It should have came down a lot more for gas, for gasoline, and we didn't see it. So it's tough on the consumer level. I will say this. Don't look at technical indicators when it comes to commodities. I mean, technical analysis is for traders. It's for short-term movements. I mean, if you look at a large home builder who's building, a massive community, they're not like, hey, guys, everybody, hold up. Lumber formed the double top. Price is going to come down over the next few weeks, and then we'll stop buying again. No, it doesn't work like that. So, the double top and everything, again, that's trading and stuff. And yes, it could result in it coming down further, whatever. But it's mostly a trading indicator. When you're looking at lumber, copper, lithium, uranium, oil, gas, commodities in general, these are driven by supply and demand. That's what they're driven by. If more people are buying houses, I don't care what the technicals say. You're going to have shortage of lumber. You're going to see prices go higher, and that's what we saw in the ups and downs, and sometimes based on who's short and what, you'll see, fluctuations of the market. But overall, when you're looking at it, it's cyclical, right? These markets are cyclical. So, again, looking at the double top, I wouldn't pay attention, but if you're looking at supply, especially homes, they're going to start coming down. And they are starting to come down as demand is starting to dry up a little bit. Even in my area in Florida, this week, from the real estate agents I talked to, there was more homes that came on the market than I want to say. I mean, I don't want to get the time frame wrong, but a very long time. There was no inventory here, no inventory. I mean, people are selling houses at I would say 15% above the average price and getting it just we're locking into contracts within 24 hours. And it's still happening. But now, even us, where we're going to sell our house eventually. I'm looking to sell my house quicker because a year from now, January 1st, my house is going to be built. I'm going to move to Jacksonville because my daughter goes to school out there. We'll be driving like crazy. So I'm going to sell my house and I'm going to live into it until that one was built. I may sell my house now because I don't know if this market, it's insane where prices are. And if they go up a little bit higher, I'm okay with that. But I didn't think I'd be able to sell my house for the price I'm going to sell at. That's how much you're up in Florida. And I might sell it and then go to a rental community and probably take almost all the proceeds of that and throw it in the market right here. That's what I'm looking to do, just to tell you. So I think Florida, Texas, Nevada, low tax states, these markets are going to continue to see strong demand as you have people from, the major California, New York, major cities. $1 million is not a lot of money to these people because that buys you like a shack in some places. Like $700,000-$800,000 is like the average home price in Queens. I'm not even talking about New York City, but in Queens and Brooklyn, the 5 boroughs, Staten Island. And that doesn't get you a nice house. That gets you like a fixer-upper. So coming here and seeing what you could buy for $1 million and be close to the water and beautiful, and none of that, you're going to save so much money in taxes that you're paying in these areas. It's going to keep those markets a little higher. And I know you say you're in Florida, that's why I'm mentioning that. With that said, 5.5% mortgage rates, it's having a significant impact on demand, not to mention more tightening with the banks when it comes to the approvals. My approval process was incredibly difficult. Again, it was a construction loan, it might be a little different. But when you're seeing these levels, it's you're seeing it. A lot of people, a lot of cancellations. You're seeing people saying, hey, I'm stepping back. You also resulting in a lot of equity in these homes not being able to be tapped because you're paying such a much higher interest rate now on that money, on those home equity loans. So you're seeing that market refinancing dry up. So you're seeing a lot of these things are going to cause demand to fall and price of materials start pulling back. And you're going to see that over the next 3 to 6 months. I mean, if you could wait, I would afford to wait, but I don't know if you're going to really see it on a consumer level, but you are going to see prices come down for materials. We really are. We're going to see that, even though China's stockpiling some, and it's not that easy to get a lot of these materials. I'm building a house and I know that, but with that said, you're not going to see the demand in houses that you're seeing right now where everybody is going to be buying no matter what. And because interest rates are so low, that mortgage rate is significant. And you're looking at $2,000 a month in payments, in higher payments. That's money coming directly from savings, money that could be filtered into the economy. It's a lot of money. It's going to prevent people from buying homes and saying just a certain percentage, not a lot, but a certain percentage right now. After that goes higher, you're going to see it go higher and higher, but you're not going to see the massive demand across all states. You're going to see it come down a little bit as all asset prices right now are getting hit. Look at stocks, you look at collectibles, look at NFTs, you look at cars starting to come down. The only thing that hasn't really come down is real estate because of one reason, because there's not enough inventory. So there's a massive amount of houses being built, and that's going to slow. Then you'll be like, all right, let's slow down a little bit right now because we don't know if we're going to be able to sell all these houses where, we could sell them immediately and they're almost sold before you start building. And that might be the same in certain areas like Texas, Florida, Nevada, but it's not going to be the same every place. And I think you see material prices come down. But again, that is up to you. And you're a truck driver. You're tied in. You probably know much, much better than me. But that's my advice. I would wait if you can. I mean, if you could wait 6 months, I think you'll see a significant difference to the point where it made a lot of sense. And again, cure for higher inflation is higher prices because that's going to result in, as those prices go higher, demand's going to come down, which is going to force prices to come down. You're going to see that materials. We're seeing that with copper. You see copper prices absolutely crash. You're going to see it in a lot of different things, in lumber and different materials. You're going to see it. It's not a huge, massive demand market right now. You're seeing it pull back a little bit, and that's going to result in material costs coming down because they're going to have to do that in order to sell some of their houses. So you'll see material prices come down, and I think the next 3 to 6 months, you'll see that. That's my opinion. Last question here, and thank you so much for all the support. I really appreciate it. Let's get to the last question from Julian. Julian says, Mr. Curzio, you can call me Frank. He says, thank you for everything you do. In light of recent news and the roughly $40 decline in Disney stock price since your November Disney discussion where you mentioned that there's more downside, do you think we're looking at more downside here or recovery scenario? Obviously, there are a lot of macro factors at play, but I'm very curious as to your take. Thanks again. So, Julian, just to be fair, during the credit crisis, I thought Disney was in big trouble, and then they went into streaming like it was the most revolutionary thing that they created ever. What they did is they were forced to go into streaming because they were more impacted than anyone during COVID because it's a 100% consumer business. They don't have recurring revenue, and every single part of their business was shut down. And it wasn't coming back soon. It wasn't like, okay, well, airlines open up or this open up. No, it was the parks, it was the theaters, it was Broadway. I mean, you name it across the board, they were impacted. They had to do something, and they went to streaming and said, okay, we'll get a multiple like Netflix of 40 times earnings, where Netflix is now 15 times forward earnings, and Disney's trading at 24 times forward earnings. So Disney's a very expensive stock. In order for Disney to work here, they have to get the hell out of streaming. They could decide now to do that and say, okay, we're going to reverse course or whatever, and take a charge or whatever you need to do. I know it's Disney Plus. I know they're not going to do that because, a lot of executives are stubborn and believe this is the way. This was something they were forced into. This wasn't a revolutionary thing that changed the landscape of the company. Like they said, the numbers were never there. I knew the numbers would never get there because streaming I covered for a long time, and it's the worst business model I've ever seen in my life. $30 billion for new content, and you're charging people like $7 a month. It just doesn't make sense. It made sense for Netflix. They went through a massive, they were able to get that huge premium, kind of like Tesla. Tesla, just people loved that stock when it was a shitty name. Yeah, they were producing cars, but now the balance sheet is much stronger. They're seeing strong growth, record earnings and everything. But you know what? They got a pass from a lot of shareholders saying, hey, this is what we think the future is going to be. And that's fine. When I look at Disney, what the future is going to be, $30 billion a drag. They don't have that money. They're sitting on $40 billion in net debt, their largest net debt position ever. They went all into streaming like it's, this is the greatest thing ever, and it's not. They can't really compete with the Time Warners and the Netflixes. You just not to spend that kind of money. It's just that's why you're not going to see earnings come back, and all the analysts are leaning so far on the wrong side of this. And the funny thing is, Disney didn't really get punished. They got punished when this market came down, and now they're finally missing, and people are starting to realize it. But they didn't really get punished for their terrible numbers for 2 quarters before that because they added more names, which were basically for free. Nobody cares about the actual numbers, right? Back then, now people are caring about earnings and the numbers. But all the analysts, when they had the reset, not this quarter, last quarter, they were like, oh, well, they're going to get back to pre-COVID levels. We thought it'd be 2022, 2023. Now we're pushing out to 2024, 2025. Like the full year of all your financials were complete horse shit, right? Imagine if we did that as a company and said, these are the goals of 2023. Then we're going to hit all these goals. And now next quarter we come out and say everything is shit. And all of our analysts decide to say, no, that's okay. They're just going to hit it in 2024 instead, which is hilarious. But, getting back to this question real quick is they don't have the balance sheet to spend $30 billion constantly every single year. And that's what they're going to need to spend to compete with Netflix and Time Warner. They need to focus on parks, movies, theaters, and start licensing their content to the hundreds, if not over thousands of streaming providers. You only hear about the big ones, but man, there's tons of them out there. License all your content to these people who are in dire need of content to keep their platform afloat. Now this is a super high margin business. You get checks in the mail, collecting them like crazy. Instead of spending tens of billions of dollars you don't have with actors and actresses, you got in trouble with Black Widow. Man, I forgot her name, and I love her too. But, the fight with that where you release something on streaming, which she didn't expect, it wasn't a contract, and you attacked her for being like, again, with your liberal shit, which, come on. She's one of the most popular actresses in the world. And Scarlett Johansson. Give me a break. So that's what you're dealing with a lot of these companies. So they need to focus on the parks. The parks are kicking ass, and you need to get the hell out of politics. Please get out of politics. You've done it with your ESPN brand, and it's crush your ESPN brand. You're doing it right now with the Don't Say Gay bill. Again, this is about stocks, not about politics, but for Disney, and Florida in general, the Don't Say Gay bill, which is the funniest thing in the world that it's coined the Don't Say Gay bill because it doesn't have the word gay in it at all. That's a more important topic right now than Roe versus Wade in Florida. Not taking anything away from Roe versus Wade abortions. I'm just saying that is a hot topic in Florida because you're dealing with people's children. Right? This is Disney. Disney's core market is families, the family experience. And you're telling these parents that their 6, 7, 8-year-old children need to be educated about transgender in school from teachers they don't know personally. That's what Disney's fighting for. That's what they're standing up at the rooftops. That's what they're calling a Don't Say Gay bill. We want our teachers, not the parents, because you're too stupid. We want them to know about transgender and teach them about their genitals. And we're going to, in school, when you're supposed to teach them the multiplication tables, right? That's what they're fighting for. That's their core market right there. Get the hell out of politics because it just cost you. It was really damaging with the cost structure, the special tax structure you had for over 40 years. That's what happens. Get out of politics, guys. People go to Disney for entertainment. People watch sports for entertainment. Don't make it about politics. We talk about politics a lot of times because we have to. It's reflected. ESG. The stupidest thing in the world. If you do it right, that's fine. If you're doing it right, even when it comes to the oil part and the energy part of that, that's fine. But at a time like this, where we can produce as much oil as we possibly can, we're hurting hundreds of millions of Americans right now with higher energy costs when we have tons of oil that we could be drilling and become the most powerful nation by far, where China's not catching up. And China is catching up because they're producing coal and doing everything they can and stockpiling to make themselves stronger, and we need them. Paying our politicians who are all on a take from China. That's why we can never say anything bad about China. Russia's the enemy, but China, no, they're cool. They started COVID and murdered millions of people all over the place and denied it. Didn't let the WHO in there. We know it, right? They lie about COVID. They lie about everything, but they're not the enemy. Why? Because look at the amount of money that filters into politicians from China. It's not a hard trail to see. And I'm not talking about Democrats. I'm talking about Republicans as well. Both of them. But it's amazing how you can't say anything bad about China. That COVID originated there. You got kicked off of social media. Why do you think that? Politics with these companies, they have to realize. They got to get out of politics, especially Disney. It's not their core market. That's a big risk. With that said, if they get out of streaming at Dubai, if they get into streaming, this company is not going to see earnings get back to pre-COVID levels for another 3-4 years. And that's the only company. I think Boeing will beat them to it. Out of every company in the Dow, probably 95% of companies in S&P 500 where their earnings have returned past pre-COVID levels, or pretty close to that. Disney's not even close. So those earnings aren't even going to be close as long as they're in streaming. It's a money-losing business. They have Hulu, which has been around forever, and that loses $1.5 billion a year. That shows you the model doesn't really work. Unless you could do something else with those names, and I know Disney's the greatest marketing company on the planet. You might be able to do a lot of different things with those names, and that's fine. market them and put them through whatever it is. But I got to tell you, even when I went to New York with my friends and I spoke to them, they're like, Florida, Orlando, when you're coming down, and they started talking about this. This is a hot topic for them. And you're like, what's going on there? And I have my own opinion about it. They're like, we're not going to Disney. We're going to Universal now. We've already booked Universal. We're not going to Disney ever again. That's what they said. Because when you really look under the hood here, whatever you support, you support. But their core market is families. And none of the families want this. None of the families want teachers to educate them about anything other than school. We'll develop our kids. They'll learn from us. They're our kids. You want to teach them something that we don't believe that's necessary for them to teach, regardless. And has nothing to do with being prejudiced, has nothing to do with not liking something or liking something. It's why. Why is this need? Why is this such a need and such a big fight to program 6, 7, 8-year-olds, innocent children who should not be learning about politics or anything craziness or anything like that? And if they are going to learn about that, let it come from their parents, not teachers that we don't know. That makes a lot of sense. You may think differently. I don't. I'm very strongly on this. I do not want my kids 6, 7, 8. Again, my kids are older now. I still want to keep them as far away as possible from all the bullshit that's out there, which is a lot. And it's not easy these days, especially through social media and crazy stuff like that. Anyway, that's my take on Disney. Hopefully they get it streaming. If not, if the market goes up, Disney will probably go up. You're going to see the parks continue to do well because they have pricing power. But their parks have been limited. So I want to see what they're going to do. They're going to further raise prices since I don't know if they're increasing the park capacity, which they're not, but they said, hey, we're limiting this way. Experience is better for everyone. So, when you limit something and you limit the amount of people coming into the parks, that means you're going to have to raise prices. And we're seeing right now that, pricing power, that's cool, but not everyone's going to continue to have it. You can't raise prices to just wherever the hell you want forever. Eventually, people kind of cut back. We're not even close to seeing that with Disney. That's their bread and butter. They need to get out of streaming. I know too much has gone through streaming and Disney Plus and all this stuff, but I would love to see that because it's going to be a major drag on earnings as long as they're in that business, and they don't need to be in that business. And if you want the multiple of Netflix, your stock needs to decline by another 25%. So, that was the goal. We want a multiple like Netflix. Well, Netflix's multiple is 16, 17 times forward earnings, I believe, right now, and you're trading at 24 times forward earnings. So what do you want to buy? I don't know. For me, I think Netflix is a much, much stronger buy, and I think people just get Ozark, Stranger Things, and the content that they have. People are going to flock there than Disney, which is not producing tons of new content. They have old content, and that's not what streaming is about. They want new content. That's why people stream. They don't stream old movies. They can get that on TNT and USA and stuff like that. So that's just my opinion. So guys, look, different format here. Went a little long for you. You just keep these 30 minutes. It's like 38, 39 minutes. I want to start taking more of your questions. I want to be here for you during these market times. A lot of people will hide and punker that people that you listen to. Not us. Okay, we want to be here for you. I know you have lots of questions. FrankCurzioResearch.com. I'm going to take a lot of questions, only questions tomorrow. So make sure, email me, FrankCurzioResearch.com. And you never know, your question may be the one I read on the podcast, which I say for my Frankly Speaking podcast every Friday, which only goes out to paid members. That's not on iTunes. So if you're a paid subscriber, you get my Frankly Speaking podcast where I answer a lot of your questions. So tomorrow, format different. Feel free to send in questions, and hopefully all you guys are doing well. And I'll see you tomorrow. Take care.